So my friends, welcome back. Sources of finance. Finance is what we are studying, right? Finance is the lifeblood of the organization. Without finance, you cannot operate. We talked about working capital management. That is also finance. We have, right, in the working capital, you have cash, bank, your money is stuck in inventory, your money is stuck with the customers. Huh? So that is finance. Right or not? Now, very interestingly, there is a terminology, accounting. Then there is a terminology, finance. Note, the designation is not certified accounting specialist. They say certified financial specialist or certified finance specialist. This is the designation of this course, right? Why? Have you thought about it? What is the difference between accounting and finance? Now, people when they start their jobs, they start accountant, junior accountant, senior accountant. Huh? Some companies even they have accounts manager like that. And at the same time, you have other roles like finance analyst, senior finance analyst, junior finance analyst, finance manager, finance, not accounting, finance manager, CFO, chief financial officer. Very rarely, I have never heard about it. Have you heard about this designation? Chief accounting officer. We have a designation CFO, very common designation in every company. This don't say CAO, right or not? I mean, CAO means Chief Accounting Officer. No, it means accounting is at a basic level. When you would say accounting, it's at a basic level. That's why when a person start the career, he's accountant. Slowly, they move towards finance. So finance is umbrella, under which accounting is a component. Getting it? So that's why you have a designation financial planning and analytics manager. They call it FP and A. This is very good designation these days. F, P and A. So if you are want to make your career in finance, this is very good job to do, because you do planning also. Like here we study, right? Budgeting, it's part of it. See, basically that is a combination of financial and management accounting. When you say finance, it means you should have a know-how of both financial accounting and management accounting. And this is what we do here. The first 4 modules purely related to financial accounting, where we make income statement, balance sheet, cash flow, interpretation. Remember, module number 5 till 12, what we just completed. This is relating to management accounting, costing, pricing, budgeting, forecasting, investment. You see, management accounting. So the merger, finance. That's why the designation is called Certified Finance Specialist. And finally, these 2 modules relating to finance overall, that from where we can get the money for the organization. Getting the story, Jenny?
Yes,
Okay.
sir.
So, if you remember, we discussed in the company chapter, I think module 2 or module 3 somewhere, when we were making company accounts, that there are 2 major sources of finance: debt, equity. Debt Equity or capital, same thing, right? In company, we call it equity. In sole trader and partnership, we call it capital, which is the money invested by the owner, right? Debt, the money which you take from the bank, from the public as a loan, debt. That's it. Two major sources of finance. Remaining breakdowns we will study in this chapter. What are the types of equity? What are the types of debt? Right? So my friends, let's go on this chapter. There's a need for finance. I told you definitely we need finance. Why? To run our operations, to do investments, right? Or not? And to pay to the owners the dividend. Definitely we need to pay, right? So that's why we need finance. So they say finance can be long term or short term. Very simple. You can take a 1 year loan also, and you can take a 5 year loan also. Right or not? Depends on your requirement. See this. This is the main point I was just telling you, that it is debt or equity. Right? So short term finance, if you remember, we just discussed in working capital. The money which I owe to supplier. The money which I owe to supplier. What's that? My payable, right? My payable, we also call it interest-free loan. Right? You buy something from supplier, you say, I will pay after 30 days, 60 days. What is this? This is interest-free loan. They will not charge interest on that, right? But you will pay later on. It's like you took loan, you purchase inventory. After 30, 60 days, you repaid. Right or not? So that is like short-term finance also. Huh? So my friends, similarly, bank overdraft. What is bank overdraft? We discussed somewhere, I remember. So you have in the bank account 10,000. You do arrangement with the bank that in case this 10,000 is fully utilized, please give me some more amount, 2,000, 3,000, whatever. That is, so you can go in minus. That is called bank overdraft. Again, short term. You should, as soon as you repay, class, they will charge you interest on a daily basis. Right? Or they say like bank loan repayable in near future. So these are some examples of short term finance, like 6-month loan, 1 year loan, short term. Long term, like they're saying, it's like equity or debt, right? Debt like more than 1 year, 3 year, 5 year, 10 year, 15 year, like that. Okay. So my friends, I want you people to quickly read this paragraph, this one, and till here, please, quickly. I'm giving you 2 minutes. Go through these 2 paragraphs and let's quickly discuss. See what they are telling, same thing, which we already discussed before so many times. Which is more risky, debt or equity? Hmm? Why? Huh? Say one person at a time. I'm not able to understand. Who will tell me? Huh?
Because the residents, residents paid after
After interest?
yes, after tax.
Yes, after tax.
Paying for
And that is also not confirmed. Remember we discussed. The dividend for equity people, that is optional. If the company decide not to pay anything, shareholders cannot do anything. They cannot go to court. No. So risky, right? You are doing an investment and you are not sure you will get dividend or not. Huh? So risky. But you know this, whenever you will get it, it will be too much. Because that's why we call it high risk, high return. So for example, if you have a bank loan, bank is taking 5% interest. But at the same time, equity people will be taking 15% dividend. Getting it? To account for that risk. Getting it? So this is what I highlighted also here in the pink color. That the higher risk in equity means that equity will expect a higher return. So you need to remember this, okay? So my friends, let's move on. In equity, we have some types like they are saying here, ordinary shares. We discussed, remember in the company chapter, ordinary share is also called common share. And these are the real owners of the business. These are the people who will get, and in case of liquidation, if the company is liquidated, they are the last people to get something, and which is nothing. So they just have to throw the share in the basket. That's it. Loss. Because other creditors will be paid off, bank will be paid off. So at the end, nothing will be remaining for them. Right? They have the voting power. In the annual general meeting, they can vote on different resolutions of the company. Okay. So in this one, also I appreciate if you people can quickly go through these 2-3 paragraphs. Same things are written. They are, and then if any confusion, let's discuss. Please read this quickly. So very interesting point, which I highlighted here. Examiner can ask you, when the company is first established, who provide the finance? And they can give you 4 options. So the answer is ordinary shareholders. Because these are the first owners of the business. When a company is incorporated, at that time, you cannot say the bank will provide. No. First, the owners will give you. You incorporate yourself, then you go to the bank, right or no? Getting the story? So this is an important point to remember for exam. So also, these are the owners of the company, real owners of the company. This also you can remember. Examiner can ask you, who are the real owners of the company? The answer is ordinary shareholders. So my friends, they are saying equity finance can be obtained in 2 ways. Either you issue them more shares or you take money from the retained earning. What is retained earning? Can anyone remind me? What is retained earning?
Profit.
Every year, right? Every year we have profit or loss, right? That profit or loss goes to retained earning after dividend. Okay, if you pay any dividend, that is also paid from the retained earning. Whatever is left stays in the retained earning. That's why we call it retained earning. Retained. It's also called accumulated profits. Clear? So this A and B, they are further explaining you in below paragraphs that retained profits are a major source of finance. and you can take money out of it. You can pay the dividend, right? You can pay dividend to shareholders, retain the remaining for the business expansion, anything, reinvestment, development, growth, whatever you want to do. And issue new shares, very simple. If you are making losses or you have trouble, you can consider issuing more shares. Or maybe you have some investment opportunity, you can issue more shares, like that. There can be multiple reasons of issuing more shares. Okay. Now, they're saying 3 common reasons to issue new shares. 3 common reasons. Number 1, to raise more cash for investment. Very simple. To raise more cash to float the company on the stock market. Okay. Like, for example, what they are talking about is, maybe when you established your company, initially you established as a private company. Now you want to go to public. Public means you want to go to the stock exchange, right? So if you want to do we call it listing, IPO, initial public offering. So at that time, this is to float the company. I mean, you have dual objectives. You want the company to be listed. This is called float. Float means take in the stock exchange. Plus, you get more cash also. Getting it? Because in the stock market, there is unlimited finance. Depends how much you want to issue the shares and how much people are willing to take. Depend what is your company. Getting the story? And finally, to finance the takeover of another company. So you want to take over another company, you need money for that. So you tell your shareholders that, see, I want to take over this company, very good for us for future growth. If you please give me some finance, we can take over this company and your future dividend will improve also. Getting the story? So these are the 3. So examiner can give you a question. Which of the following is not a reason to issue new ordinary shares? Which of the following is not a common reason? See the question. 3 common reason, right? Common reason. Which of the following is not a common reason? So 3 they will give you these ones and 1 something else. So you have to select that 4th item. Clear? Like, for example, they can give you an option to repay the loan. To repay the loan or to run operations. Anything like this they can give you. So you can select it. Clear? Any confusion? Clear? Next. Raising equity finance, stock market companies. And then the issue, okay, we have 2 more items here, 2.3, 2.4, and then we have another topic coming in. So they are saying the reasons why a company might seek to bring the share to the stock market. Why we need to go to the stock market? This is the question now. Why we need to go to the stock market? So please quickly read this 3 items and then let's discuss. Very simple points. You already know this. Like, different big companies, they are private company, but very big company. Like, I remember Saudi Aramco, right? There were news they want to go public 1% only. How much? Remember, 1%, and it was also in billions and trillions of dollars, which they will do. 1% of the company only. Public. 99% will stay with the owners, the previous owners. 1% only they will do public. I don't remember they have done or not till now. But this is what they are saying. So why they want to go public? Because they want access to a wider pool of finance. Because for example, if we people are here sitting here, 10, 15 people, we have limited amount of money which we can give to the company. But when you go public, that's unlimited, because many individuals will invest small, right or not? Maybe 1 million shareholders will buy one share. That's also good, right? Maybe worth $100. So $100 share, 1 million people if they buy, how much will come? $100 million. How much will come? But for every individual, that is $100. But for company, big amount, right or not? So that's the point. Improved marketability means, it's easy for people to buy and sell the shares in the stock market because it's in small denomination. If you are shareholder in a company and you have like 10 shares worth 1 million real, for example, it's very difficult for you to find a buyer for that. You want to sell your share in a company, 10 shares only, worth how much? 1 million. Very difficult. But if you are in a stock market, it becomes easy because small denominations, shares are more. So you will find multiple buyers for your shares. That is point number B. Point number C, transfer of capital to other uses. Like they are saying you that, same thing, you want to dispose of your holding so you can focus on something else. Getting it? That is one of the reasons to go public. Getting the story? You need money out of the business so you can do some other business. You can invest somewhere else. That's why many people, what they do? They start up a company. They take it to heights. When the company has a good image, they sell the company. They get the money out of it and then they do something else. Rather than keep doing the same thing. You understand? So my friends, then they say the issue price for shares, very simple. Remember we talked about nominal value, par value, face value, same thing. $1, $10, whatever. That is the amount of attached to the share. That is the common share value or ordinary share capital, we call it. If you are selling the share at more than par value, that is called premium. Right? Like par value $10, but you sold it for $15. So the extra $5 which you are taking from the shareholder, that is called premium, share premium, written in equity. Okay. So this is what is written here also. And also they are saying that you multiply the price of the share with the number of shares minus the issue cost. If there is any issue cost, you need to remove it. Okay. And there is something called underwriting commission. What is underwriting? Normally, when you are planning to sell the shares, there is a risk that not all shares might be sold. So you take help from a commercial bank, investment bank, any broker, any other party, and they give you undertaking. They say if all the shares are not sold, so the shares which are not sold, we will buy. Getting it? At some commission. So that is called underwriting. You got the point? Because to cover up the risk, maybe you are issuing 100,000 shares. So 90,000 shares public took. 10,000 shares no one took. So these 10,000 shares, who will take? This underwriting party. It can be a commercial bank, like I told you. It can be an investment bank or any other broker like that. Okay. At a commission. So they will buy it from you at a lower price or something, and then later on they will sell it and they will earn out of it. That is the strategy. You are getting the story. So my friends, till here any confusion? Right? So we covered around 3 pages from here. We talked about ordinary shares, major. Obtain a listing, this third area of the chapter. So can you people quickly read this area? 1, 2, 3, 4, 5 paragraphs, and then let's discuss. So they are telling you how you can obtain a listing on the stock exchange. What is the procedure? I'm giving you like 3 minutes for this. Okay, so very simple. They are saying same thing. I told you before also, when you go on the stock market, we are floating. It's float. It's called float, the terminology. It can also be called as listing, right? They say the company is listed on the stock exchange. You got my point. This is the way we name it. Float, list. Clear? Now they are saying, when the company is going for the first time, so it is possible that you are a small baby right now, company, not too much big. So stock market, they have a criteria. Okay, they cannot take every single company. So you need to fulfill the criteria. Maybe the criteria can be that your revenue should be like 1 million, your profit should be this much like that, or your assets should be this much like that. Okay, with some other requirements like audit has to be done, or you should be in existence for like say 5 years, like that. There can be multiple requirements. So if you don't fulfill those requirements, you cannot list on the main stock exchange of that country. Getting it? However, there is a baby stock exchange also. You can say that is called, like in the UK, they call it alternative investment market. Okay, so initially you can go there. Once you fulfill the requirements, you can transfer to the main stock exchange, like Financial Times Stock Exchange, Tokyo Stock Exchange, London Stock Exchange, New York Stock Exchange, right? These are the main stock exchanges in the world. I think Nasdaq, they call it Nasdaq, right? There is a website you can go like that. So my friends, and similarly, they are saying you can maybe either going for the first time, or you already have some shares listed and you want to issue more shares like that. This last thing is very important. They're calling some terminology here, tandem. What is this tandem? See, you can, when you are issuing your shares, you can issue in two parts. Okay, there are some shareholders who are called institutional investors. Who is institutional investor? Who buy in bulk quantity. Okay, like not one or two shares. They will buy like 10% shares of the company, 20% of the company, like that. Big amount. Getting it? So they are called institutional investors. Apart from that, you can do intermediary offer. That is what I just told you before. You can agree with a commercial bank or investment bank. They will act as an intermediary for you. Okay, so through them, you can sell shares. So if you have any bank account, so you might have received some notifications from your bank that this company IPO is going to come. So if you are interested, you can buy the shares of this company through our bank. Getting it? So they give special offers. So it depends which bank you are in and which company is approaching your bank. Getting the story? Okay. So this is, huh?
How much they are willing for the money? You have to fix them, right?
Definitely, nothing is done for free. So there will be some arrangement, right? Win-win situation. So there can be a commission, there can be something. Depends on contract, right? So my friends, the next topic is offer for sale and offer for subscription. This is still we are going, we are talking about the share issue in further detail. Then placing intermediary. See, what I just discussed with you, it's coming in further detail. That what is placing, what is intermediary offer, what is right issue. Okay. So same, this one, let's quickly go through it. Offer for sale and offer for subscription. Please read these 2-3 paragraphs quickly. This one here. What I am highlighting in the book, better you also highlight, because later on you will not have time to read everything again. Okay, and don't keep your book clean. Write on it, annotate. Book likes it. Getting it? You will also like it. Because later on, if you are revising this chapter, you can revise in 5 minutes. Because you have annotations, highlights, like that. Okay, my friend. So, very simple, right? They are saying the two most common method of obtaining a listing is offer for sale or offer for subscription or placing. Okay. Again, remember, make a note of it. Offer for sale, offer for, this is same, offer for subscription or offer for placing, same thing. So they are telling you what is offer for sale is an invitation to the public by existing shareholders to purchase shares that are already in issue. Getting it? So very simple. I mean, this is when they are going, you have shares and you want to sell the shares which are already in existence. This is called offer for sale. Offer for subscription is something new. The shares are not yet issued and you are inviting the public to get new shares. You got the story? Invitation to the public. By whom? By the company. Okay, question for you. Offer for sale is invitation by company. True or false? Offer for sale is invitation by company. True or false? False. Why? Because offer for sale is invitation by shareholders. Like I am a shareholder in a company and I want to sell my share. This is called offer for sale. What is offer for subscription? This is offer by company to the public that I want to issue more shares. If anyone is interested, please buy. Simple. You got the story. So you need to remember this. See, this last paragraph is summarizing it all. The difference between offer for sale and offer for subscription is whether the shares are already existing or new to be issued by the company. You got the story? This is the main difference. Then they are saying like issuing houses and sponsoring member funds. So when unquoted, you can write here unlisted, unfloated, all same things. Unfloated means not yet floated in the stock exchange. Unlisted, not listed, same things. Okay, different names can be used. The company which is not yet listed on the stock exchange is called unquoted company. So they are saying if you want to go on the main stock exchange, you need a sponsorship that is already a member of the stock exchange. Like, I have done a qualification, CIA, Certified Internal Auditor. Okay. I am a CIA myself. So if anyone wants to do CIA, when they put their application to enter into the program, they need another CIA to sign for them that I know this guy and I take responsibility or something. Like there is a form you have to, like reference form. Same here. If you are going in a stock exchange, a company already listed in the stock exchange need to sponsor you. Like a reference. Like you apply in a company for a job, they take reference, right? Yeah. Like that. So see what they say, this is sponsoring or member firm has the responsibility of ensuring that the company meet the requirement for listing and carry all the necessary procedure to apply for a listing. Like, so they can guide you, they can support you because they have already done that procedure. So they are in a better position to help you. You got the story? Because there are so many requirements, so many documentation has to be done. So they can be a good help for you. Okay, please note, by sponsoring doesn't mean they are giving you some money. Sponsoring means they are giving a reference to you and they are supporting you to get listing done. Clear? So they are saying there can be, you can also take a service of an issuing house, which can also be this sponsoring company to ensure a successful issue of the company shares by advising on the issue price. See? And trying to, okay. So again, this sponsoring firm or another firm. Okay, you need to take help of a company which is called issuing house. What they will do? They will advise you how much you should set the price. Because they have a know-how of the market. They know that how much price if you set, you can be successful. They can also give you their contacts of the investors. They can take you to their own other investors that this is a new company trying to enter in case you are willing to invest in this company. Remember institutional investors, I told you, big buyers. You got my point? So basically, my question for you. A sponsoring company can act as issuing house, true or false? A sponsoring company, sponsoring firm can act as issuing house, true or false? Right? What they say, the company can also employ the service of issuing house, which might well be the sponsoring firm itself. So my question to you is that the sponsoring firm can act as issuing house or not? It can act. You got my point? Okay. So now another question. Issuing house can act as a sponsoring firm, true or false?
Yes.
Issuing house can act as a sponsoring firm, true or false? False. Because issuing house cannot act as a sponsoring. Sponsoring firm can act as a issuing house. There is a difference. Who is a sponsoring firm? A company already listed in a stock exchange. They can help you to fill up the documentation requirement and everything. Clear? They can act as a issuing house also. What is issuing house? They will support you in setting a price, in getting some investors like that. Okay. But if you say no, issuing house, I want to engage some other company. Issuing house, I want to engage some outside company, outside firm. This issuing house cannot act as a sponsor because that is not part of the stock exchange. You got my point? Sponsoring firm should be part of the stock exchange. Already they are there listed. They can act as a issuing house. But if you take service from a issuing house which is not in the stock exchange registered company, they cannot act as a sponsoring firm. Very technical point, but easy point. Clear, my friends? So examiner can ask you these types of questions. Underwriting an issue. Again, please quickly go through it. I already explained to you what is underwriting. What is underwriting? You issue some shares. Not all the shares are taken up by the public. So who will take? The investment bank or the commercial bank who is helping you, right? So read these 3 paragraphs quickly, please. Very interesting point, my friends. First of all, examiner is asking you. Underwriting is usual or common for small share issues? True or false?
False.
They're writing because it is common for large share issues. Number one point, remember. Okay, it is like an insurance. It is like risk reduction. What risk reduction? In case I issue 100,000 share, 90,000 public has taken, 10,000 not. So these 10,000 who will take? The underwriter. Why they will take? Because they will get commission. I will pay them commission because they have taken the risk. Now again, it is not necessary that they take all the shares. Maybe they don't have money. So they will have sub underwriters. There is a network. So if, for example, if you don't have money to buy 10,000 shares, you will ask your sub underwriter, another friend company or whoever, that 5,000 I can take, 5,000 you take. So we will share the commission. We will share because we need to pay to the company, right? We need money to pay to the company. I don't have money of 10,000 shares. I only have money for 5,000 shares, right? But as an underwriter, I need to buy all the shares. There is no option to buy half. No, whatever unsold, I have to buy. You got the story? So who will buy? I will engage other people in my network, and this is how it works. So if I am getting $10 commission per share, I will tell them, okay, you buy these 5,000 shares, I will pay you half of the commission. You got the story? So remember these points. Issue price. Question for you. Who advised company to set the issue price? Sponsor, sponsoring firm, or issuing house?
Issuing house.
Examiner can ask. We just discussed above, my friends. What? See again, read this. What is the responsibility of issuing house? To ensure a successful issue of the company share, advise on issue price of the share, and try to interest the investors in buying the three things. What is the responsibility of sponsoring firm? Ensure that the company meet the requirement of listing, carry out necessary procedures to apply for listing. So it's more about procedural stuff. Sponsoring company will help you in procedures, but issuing house will help you in strategy, that how much price you should set, and also help you in some investors getting some people to buy your share, like that. You got the story? So examiner can easily ask you this thing. So remember. Okay. So read through these three paragraphs quickly, and then let's discuss. Okay. So, my friends, if you remember, we did interpretation of financial statements, right? Module number 3 or 4, where we discuss some ratios. So, there we discuss P ratio. I told you that is confidence of the shareholders in the company. What is the formula of P ratio? Remember? Market price divided by earning per share. It means if a company is earning, for example, $1 per share, the market price, let's say $10. Why a person will pay $10 for something which is earning $1? Think about it. I mean, you can see there is a company, they are earning $1 per share only. Will you be interested in buying that share for $10? Maybe yes, maybe no. But if the price is like that, it means their shareholders, they have confidence in the company. Why? For future. Because they know the company is earning $1, but there is future potential, future growth. So they are ready to pay $10 for it. Right or not? You got the story. So my friends, that's what they are saying. The price is usually advertised being based on a certain P ratio, because investors, they need to compare also that which company has more P ratio, which company has low P ratio. Accordingly, they will invest in your company, for example. Apart from that, what is written in these paragraphs, it is that, see, I highlighted for you also the question which I was asking you, that who will advise the company? Issuing house. See, it is a common practice of issuing house, like, so they are helping you to ensuring that your price is reasonable. Okay. Then this middle paragraph is very interesting to understand. They are talking about oversubscription and undersubscription. Okay. What is undersubscription? If you price too much, if you price too much, so definitely there will be some shares which will not be sold. Right or not? If you price too much something, so it will not be sold off fully. So that is called undersubscribed. When it is undersubscribed, who will buy those shares? Underwriter. Remember we discussed. If you are issuing 100,000 shares, 90,000 public took, 10,000 no. So who will buy these 10,000 shares? Underwriter. It can be investment bank, commercial bank, okay, any broker, whatever. So my friends, this is the problem in overpricing. Because if you overprice, underwriter will come into the picture. I have to pay commission also. More loss for me. Wake up. You got the story, everyone. So that's why you should not overprice. And similarly, you should not underprice, because if your price will be too low, it means many people will be interested to buy your shares. So you have invited for 100,000 shares, but you receive applications for 150,000 shares. Getting the story? But definitely you cannot sell, because your limit is what? 100,000. So you will issue 100,000 shares maximum. You got my point? So that's why you need to keep the price somewhere in the middle. And this middle thing, who will help you to decide? Issuing house. Clear? Online people, clear?
Clear.
Okay, then they say offers for sale by tender. Again, quickly go through it. I'm giving you 1 minute. Then we will discuss this. Very simple. They are saying the prices in the stock market are rising. So you are not sure about what price to set. So you can offer the sale by tender. Like, auction. Okay, when you auction something, you set a minimum amount.
Understand.
And then people, they bid. Whoever bid the highest, they get the property or the asset, right? On same here. So you will set a minimum amount, and then you will tell to the shareholders to tender. So see, minimum price is fixed, and the investors are invited to tender for shares equal to or above the minimum amount, then allotted to the successful bidders at the same price, which is the highest price. This is known as the striking price. Like same concept of auction. Okay. So this is also a good strategy, but when the market prices are rising. Examiner can ask you. Examiner can ask you that in which situation offers for sale by tender is a good approach. When the market prices are going down, are going up, or stable. So you need to remember, when we will do the tender, when the prices are going up, then only, not when they are going down. You got the story? Because what is the objective here? To earn as much as possible. What is the objective of auction? To generate as much as possible. Right or not? So this was the fourth area. So my friends, placing. What is placing? They're saying either existing shares or new shares are offered to investors in a selective marketing process. Not offered to the investing public generally. Important point to understand. So it means you are not offering to the general public. You are offering to some specific investors. Okay, that is called placing. Again, please, if you can quickly read it. 1 minute I am giving you, then we discuss. Remember, I used this word already with you. Remember, we just discussed. Who are institutional investors? These are big investors, 10, 15, 20% they buy. So when I am selling to institutional investors, this is called placing. This is the word they use it. Okay, so it's not for general public. So, one more important point is that maybe the number of shares which you are selling, it's not that much big possible. So they're saying you can use placing when the subscription is small. The quantity of the shares you want to issue is small. Why? Because there is a cost of issue. So you will only go for public offering when you want to issue so many shares. Right or not? If you want to issue limited shares, small number of shares, maybe with big amounts, because institutional investors, they buy with big amount also. So they are saying otherwise the cost of offer of sale or subscription is not justified. Then you go for placing. You got the point? We don't go for flotation. You remember we discussed this flotation. flotation on the stock exchange, public, right? Placing for institutional investors. Okay. Then they say the requirement of the authorities that an adequate quantity of the company shares will be distributed to the market is met. So again, maybe there are some requirement which you need to fulfill to reach to a certain number of shares only. So then you can use placing. Instead of going public, I mean offering to the general public, you only offer to whom? To institutional investors. You got the story? Okay. Now, what is intermediary offer? Here we go to the public. Through intermediary, can be commercial bank, like stockbroker, dealers, investment bank. Less than in an offer for sale or offer for subscription. Remember, we discussed this already above, that what is offer for sale or intermediary offer. Now it's coming in more detail. I told you it's coming in more detail. So they are saying when we do intermediary offer, this is less than if you offer for sale or offer for subscription, which is coming, which is like open issue. They are saying you can also use it in conjunction with placing, like both together. That placing also and then intermediary offer. Like if you remember, we read something above, which are done in parts. The word they used, tandem. Remember this word we just discussed, tandem? Where was that word? Yeah, here. See this. The various method of bringing security can be used in tandem. So might make an offer in two parts, in trenches. One, placing with institutional investor. This is placing. See, highlight this. Highlight like this, so you remember. Like 2-3 circles make here on this placing. Make circle, but don't make like this. Otherwise, you will not be able to read it. Getting it? How you will make the circle? Like this. Proper circle. Sorry, this is not a circle. You got the story, everyone? So they are, see, they already mentioned this word placing. So when we sell to institutional investor, we call it placing. Clear? So let's move on. Okay, who can be intermediary? A broker or dealer on the stock exchange, typically. But you can also, like I said, take help from investment banks, commercial banks, like that. Okay, this example you can read through later on. Mark it as homework, please. Very interestingly, we don't have so many questions and exercises till now because it's pure theory, concepts only. That's why I am giving you exercise in the middle. I am asking you questions. Rights issue. Preemption rights. Very simple. Remember, when the first time the company was formed, we discussed the issues, the shares are issued. Remember? When you form the company the first time, who give you finance? Ordinary shareholders, real owners. At that time, you were a baby. Small company, new company, not sure what will happen in future. 1 year gone, 2 year gone, slowly, you are now growing. You are getting success and you need more money. So you want to issue shares. So don't you think that the people who trusted you initially, they have a right that I consult them first, that I want to issue more shares. Are you interested? If not, then only I go to the other people. Right or not? I need to inform them. I need to issue them first. If they say, no, no, we don't want more, then I go to external parties. This is called rights issue. This is called preemptive right. This is called right of your original shareholders, right of the existing shareholders. Because they trusted the company when the company was nothing. You got my point? And also there is a big issue here. Let's say when the company was started at that time, 10 people, they invested. So 10 people means what? Every person, let's say equal investing, they have 10% share. 10 people, 10 shareholders. Every shareholder has how much shares? 10%. Total how much? 100%. So you want to issue more shares, more 10 shares. So if I don't consult these 10 people and I directly go public, what will happen to their holding? So 10 new owners will come in. So now the number of owners, how many? 20. So their holding before was 10%, it will become 5% now. So their holding is going down, which is not good for them. So I need to offer them first. I want to offer them that, see, I am issuing 10 more shares. Are you interested? Give them a chance. Maybe they are interested to keep the holding.
Yeah.
Right or not? Or maybe 9 of them say no. One person say yes. And he say, I want all 10 shares. Give me, no problem. To increase the holding. Like this, you increase the holding, right? Or not? Like that. So this is called preemptive right. Okay, then remaining same thing written, you can read later on. Share option scheme. What is share option scheme? For selected employees, normally high level senior employees. You are giving certain employees the right at a future date to subscribe for new shares in the company at a price which is determined now. Why I do this? I want my senior people to work hard to increase the profit of the company, share price of the company. I don't know how that is possible. I will tell them, okay, after 3 years, if you stay in the company, if the share price of the company is above this figure, profit is this much, whatever, you attach some requirements. Then you have the option to buy 100 shares of my company at this price. Let's say the price is right now, the market price is $100. You tell them after 3 years, you can buy the shares of my company at say $120. How much? So after 3 years, these people who have the options now, this is called option, not necessary that they utilize it. After 3 years, they want the share price to be how much? Tell me. Huh?
More than 120.
More than?
120.
More than 120. Because they can buy at how much?
120.
120. So if the price is 150, 200, 300, whatever, the more, the better for them. Because they will buy at 120 and they can go in the market and sell for whatever price going on. Like a bonus for them. You got the story. But here comes the problem also. Because accounting can be window dressed. Accounting can be manipulated. Fraud can be done. Right or not? Misrepresentation can be done. So to change the profit figure, right? Because we have depreciation, we have provisions, we have estimates, so many things can play with it. So they will try to play now with the numbers also possible, which many companies did. There are multiple examples in the past. So which result in collapse. So when you design this type of scheme for the senior members, so there are big risks. Return also possible. I mean, if they are loyal to the company, if they behave honestly, very good thing. But you know, human might go crazy sometime, right or not? To act in their own self-interest. So this is something, I think they have not mentioned it here, but I told you. Okay, so this is share option scheme. Clear, everyone? Again, this is what option, remember. So it's not necessary they utilize it. Scrip dividend, scrip issue, stock split. Very interesting points. Scrip dividend. So what is, it's like free dividend. You can write here, it's dividend in terms of shares. So what happens is you are not having cash. You are not having enough cash, enough liquidity, you can say. Liquidity is not good. But shareholders are expecting dividend. Remember we discussed. I am not supposed to give them dividend because it's optional. But if I don't give dividend, they will be sad. The market will get a wrong signal that this company not giving dividend. So my investors will go away. Maybe new people will not buy shares of the company. This is a big problem, by the way. Remember, it's not very easy to not give the dividend, although it's optional. But you have to justify why you are not giving the dividend. You understand? You're not getting my point. Like for example, bonus in your company where you are working right now. Let's say they were giving you bonus. Well, it's a good thing, bonus.
Yeah.
Suddenly they stopped. And they said Corona is there, big problem. So we cannot give. Now there is no Corona. Still they are not giving you bonus. So you will be demotivated or not?
Yes. Yes.
As you can see, the company is progressing well. You are also working hard. Revenues are coming in, but the company is not changing the policy now. So what you will do? You will change the company most probably if you have an opportunity, right or not? Same here. Shareholders not happy. What they will do? They will dispose the share. They will go in the stock market and they will dispose the share. They will dispose the share. Okay. To whom? To another investor. Why another investor will buy the share? See, other people also, they will only buy when they can see the company is giving dividend, the company performance is good, whatever, they will also see, right? If they can also see that the company is not giving dividend, they will also not buy. So there will be big problem for your share. The share price will. So no new investors and existing investors also unhappy. This is the worst scenario for a company. To avoid this scenario, you need to keep them happy. But you don't have liquidity. So what to do? Give them free shares. This is the answer. What is the answer? Scrip dividend. Scrip dividend is what? Give them free shares. Then you say, okay, those who have one share, we give them one additional share. Free. One more thing. Why you give scrip dividend? Understand, please. You don't have liquidity problem. This is second scenario I am telling you now. You have good liquidity position, strong cash flow. However, okay, share price shooting up. Everything is going good. You are in a position to give cash dividend. No problem with that. However, the share price is too much. I mean, increasing. When there is something, the price of which keep increasing, you will hold it or you will sell it. Hold it. You will hold it.
Oh.
Like for example, you have a car. Okay. So you can see that the price of the car is increasing. People are demanding it. So you will not sell that car. You will wait. You will say, let it reach to the peak and then I will dispose it. Same here. So there is problem for company now because shareholders are not trading. Those who have the shares of the company, they are holding it. Not trading. No trading, big problem for company. Shares should keep trading. Huh? So what I did, for example, I have 1,000 shareholders. I gave them 1,000 free shares. So when you have a share which you are not ready to dispose, you get another free share. What you will do? You can dispose it in the market to earn out of it. So in economics, we study this. Supply increase, price goes down. So my intention was to bring the price down a little bit so that trading again starts. Right or not? If you increase supply in the market of any product, the price goes down. So this is a technique to do this also. Clear? So I am not sure that is written here or not, but I gave you this. So if you want to write, you can write because it's not written here.
That's how we know that's the share is in this peak.
Again,
How we know that the share is in this peak? It means its highest price.
that one, see, like for example, you have foreign currency fluctuations, right? So sometimes you can see that the currency is going high, sometimes low. So from past experience also, you know that my share price is overpriced or underpriced, and based on the market
It's not-
factors, based on what other companies are performing, you can also see, right? Maybe your competitor price is going up by 5%, but your price shooting up by 10-15%. Like that. So many types of analysis has to be done to know when you are at peak. You got my point? Script issues. Bonus issue. See, what is script dividend again? It is a dividend payment which takes form of new shares instead of cash. Scrip issue or bonus issue is issue of new shares to existing shareholders by converting equity reserve into share capital. Okay, so see, in the scrip dividend, I issue new shares. In the scrip issue, I am also giving free shares, but this is not issuing new shares. This is converting my reserve into capital. What is my reserve? Retained earning. So if I ask you what is not bank, if I ask you in my equity, I have retained earning. I have what? Retained earning. So what is the double entry for bonus issue? I reverse it. I say retained earning debit, share capital credit. So just a shuffling in my equity. Within my equity, I shuffle the amount. From retained earning, I transfer where? To the capital, to the share capital. This is called bonus issue. Okay, it's a very slight, small difference. So focus here. See, please. So let's say this example. Let's say if the company issued share capital of 100,000, $1 is the par value. 1 for 5 scrip issue. So I say, okay, who has one for 5? So who has 5 shares? I will give 1 share for free. So if you have 100,000 shares, so how much you will give free? 20,000. Because for every 5 you are giving 1. To existing shareholders. Okay. So your how much is your par value? $1. Okay. So what will happen is basically, let me write for you the double entry. It will be like this: debit, retained earnings, and credit share capital. By how much? $20,000. Clear? Again, same thing they are telling you, which I just told you in this paragraph, that you want to make it more marketable. So the price comes down and people start to trade. Okay, my friends. What is stock split? Stock split, like you have, for example, here above you see, in this example, I had 20,000 shares. Oh, sorry, 100,000 shares. And what is the par value? $1. Stock split is you break the par value. Okay, so if I want to break it into half, so the number of shares will become 200,000 and the par value will become 0.5. Getting it? Total amount will stay the same. So number of shares will become 200,000 and the par value will become 0.5. Like that. So this one is called stock split. So see, each ordinary share of $1 is split into two shares of 50 cents each, thus creating cheaper shares with greater margin. Same concept. I want more shares to be there in the market which can be traded. Okay, very important point, my friends. Do you understand this paragraph, which is now highlighted in this light blue color? Very important point. This is the basically bottom line of my discussion. The difference between stock split and scrip issue is that the scrip issue convert equity reserve into capital. The entry which I made for you, remember? What is the entry I made? Debit, retained earning, credit, capital. But whereas the stock split leave the statement of financial position reserves unaffected. So there is no entry. Because you are just changing the number of shares increase, par value decrease. No change in the total amounts. They stay the same. So examiner can ask you that in which of the following the statement of financial position reserves remain unaffected? Scrip issue, stock split. The answer is stock split. Clear? There is no double entry. Huh? In stock split, there is no double entry. Remember this. This one is marked as homework. This one, 9.4 homework. This is just an insight they are giving you about what can be the impact on the shareholder wealth. Okay, moving on. They are talking about repurchase of shares. Did we discuss this in the company accounts? Did I tell you? Once, remember we discussed redeemable, irredeemable, right? Preference shares, redeemable, irredeemable. Huh? So I told you, let me repeat it for you. Ordinary shares, once issued, will not be repurchased by the company. If the shareholders want to sell it, they can go in a stock exchange and sell it. The company will not buy back because they are issued in existence indefinitely. You got my point? Preference shares. You need to see which type of preference share. Is it irredeemable or redeemable? If it is irredeemable means the company will not buy back. So I told you, if you remember, it is like equity. We write in equity. Huh? Irredeemable means the company will not buy back. That is called equity. Redeemable, the company will buy back. This is like a loan. Debt. So you write in the liability. Okay. Now again, the company is not supposed to buy back equity. The shareholders cannot compel, the shareholders cannot force the company to buy back the shares. However, if the company wants, on the wish of company, they can buy back. You got my point? You're not getting my point. Again,
Yes.
in simple terms, the company is not having an obligation to buy back the equity shares, but they have the right to buy back. You got the story? They don't have obligation to buy back, but they have the right to buy back. So if the company want, they can say to the shareholders, we want to buy back the shares, please give us back. We are giving you money, khalas. Take more than the market price, give us back, khalas. This is called treasury shares. What we call it? Treasury shares. Okay. So when the company repurchase some of the shares, you can even cancel them. You will reduce the capital, and they are called treasury shares. And you can put it in a reserve also called capital redemption reserve. It is in minus. When you repurchase the shares in equity, you write in minus because that is a negative figure. Why you will do this? Because you might feel that you have too much equity now. So you want to reduce a little bit to be a little bit in line with industry average. Because if you remember in the interpretation of the financial statements, we discussed about gearing, how much is your debt, how much is your equity. So you need to balance a little bit. So it's just like a tweaking of your balance sheet. Getting the story? So, and you also know this very well that equity is expensive. We remember we discussed. Equity is expensive. They demand more return. So if you are looking to have more cheap source of finance, you can shift towards more debt. Because debt is cheaper source of finance, although risky, more risky as well for you, because it's a commitment. You have to pay the interest. Right or not? But cheap source of why? Because it is tax deductible. Interest is tax deductible, right? And what else we have for the debt? The amount of interest is low, right? Cheap. Clear, everyone? Again, you need their consent, by the way. It's not like you will go with a pistol to them and you will say, sell the shares. No, you need to take their consent. And how they will give the consent? Definitely, you will give them some motivation. You tell them, okay, see, the share price right now is $120. I am paying you $130. Sell the share. Getting the story? So my friends, by the way, in this paragraph, they are only mentioning that you are repurchasing and later on cancelling them. However, you should know this. It is also possible that you repurchase it, keep it in the reserve, this capital redemption reserve, and later on you can reissue. It's not necessary that you cancel them. Okay, you repurchase right now. Later on, if you want to reissue, you can reissue. Like that. Okay, remember preference shares, I told you they don't have voting rights. Why they are called preference? Because their dividend is fixed. And before the ordinary shareholders, they get the dividend. That's why preference. Clear? So this is all what is written here. You can read through it. That is not a big issue for you. Okay. Loan stock. See, slowly we are moving towards debt. This is now below. We are talking about debt, loans, see, loan, overdraft, like that. Okay. So loan stock or bonds, very simple. If you like to take loan from the public instead of taking loan from the bank, you can issue loan notes, loan stock or bond. Getting debenture. Different names are used. Debenture, loan note, loan stock, bonds, like that. So you tell public, okay, take this piece of paper. This is a bond. Give me $100. Every year I will give you 10%. After 5 years, come back to me with this piece of paper and I will give you your $100 back. Simple. This is like a bond, like a loan. Every year you have to pay interest, and after 5 years you have to repay the loan. But not to a bank, to the public. This is the difference. You got the story? So see, they say the term loan stock, bond, debenture are often used interchange. I just told you, same thing. Clear? So again, debt securities can be listed on the stock exchange also, traded on the stock exchange also, possible. So you took a bond in a company, and if you want to dispose it, you don't want to keep it for 5 years. You want to dispose it. So you can go in the stock exchange and you can dispose it if there are buyers. Like same like the shares. Clear? So it means there is a market. But if you take loan from the bank, that is a commitment with the bank. Right or not? It cannot be sold off, that liability. Right or not? Bank finance, very simple. You people are champion in this now, right? Okay, so it can be, I mean, they are telling you why you need bank finance, because day-to-day operating requirements, very simple, nothing to explain here. You can also need for what? To finance your capital expenditure. Remember, we discussed in the very start, why we need finance? For operations, to run my operations, to do some investment, I need finance. So you can take bank loan for that, possible. So committed funds, it can be committed or uncommitted, that the lending is pre-arranged and can be accessed by the borrower at any time up to the maximum amount of the facility. For example, if you have a bank overdraft facility of $5 million committed up to 31st of December 26, the borrower can run up an overdraft of up to 5 million at any time up to 31 December 2026. Yeah, this is same thing they are telling you. Remember, we discussed overdraft. So you have a facility with the bank committed that up to this period, I can go in negative. So the bank cannot take back that limit from you because they agreed with you, right? They committed with you that we will give you this limit. Clear? Now it's up to you whether you want to use it or not. But it's there. Okay. Why they will do a commitment? Because they will charge you a commitment fee. Like annual charge or something, they will charge also. No matter you use it or not, you have to pay the commitment fee. Because that is for bank also big risk, right? Like that. Okay. It can also be uncommitted, they are saying. In uncommitted situation, the bank has no obligation. So in case you might require overdraft facility, the bank will decide whether or not to lend you extra money at that time, depending on the situation at that time. You got the story? This is called uncommitted. So again, it depends on your company performance, your company financial liquidity position, many things they will consider before giving you a commitment facility. You got my point? When you give someone a commitment, why you will give a commitment? Because you rely. You think you can rely, right or not? So if the bank think they can rely on this company, they can give commitment. But if the bank can see this company is unstable, uncertain situation, they will not give the commitment because big risk. Maybe you take the overdraft, later on you are not able to repay and you run away, whatever. Many things can happen, right or not? And then they are explaining you what is overdraft. I told you already, it's like a short-term borrowing requirement. You can go in negative. You will pay interest when you are in negative. As soon as you come in positive, interest stops. This is overdraft. Clear? So normally it is used when you have, day-to-day requirements and uncertain situation is there. Sometimes you need to pay to the supplier, but you don't have money in the bank account, right? So then you have to go in negative. The bank will honor your check. The bank will honor your check because you can go in negative. Otherwise, if your balance is not there, what will happen? The bank will dishonor your check, which is a big problem for you. Legal issues will arise also when the check is dishonored, right or not? So my friends, then term loans, very simple. It is for a specified amount for a specified time, 1 year, 2 year, whatever. It can be on a fixed rate, it can be on variable rate, depends. Right? What is variable rate? Like for example, they are saying it is at a margin above the London interbank offered rate, LIBOR, which is called LIBOR. Here also we have a rate from the central bank. So they say whatever is the rate of the central bank, for example, above that 5%. You got my point? Variable rate. So you took loan from the bank. They said the Qatar central bank rate plus 5%. So if Qatar central bank will increase the rate, you have to pay more. If they decrease the rate, you will pay less, which is very rare. Normally the rate goes up. You got the story? This is called variable rate. What is fixed rate? They set a fixed rate with you, okay, 2-3 year loan, you pay fixed 7%. Khali what is the central bank rate? We don't care. Okay, so they say, okay, 7% fixed. You clear? Got the point? Very simple. Then there is a concept of leasing, one paragraph only. You know, right? What is leasing? Instead of buying an asset, like you want to buy a car. Now, so many offers are going on these days, right? So instead of paying upfront all the amount, you pay like 10%, and then over 4 years, you can pay installments, right? This is called leasing. Now it depends at the end of the term, you can get ownership or not, depend on agreement, right? So there are mainly two types of leases. One is called finance lease, in which ownership will transfer to you. Another is called operating lease. Ownership will not transfer. It's like rent a car. Okay, so this is like they are telling you finance lease, operating lease. It's like operating lease is what? Straightforward rental payment. Okay, what is finance lease? Okay, there are two parties. In lease, there are two parties. One is called lessor, other called lessee. Who is lessor? The owner. Like if you want to buy, let's say Honda car. So the Honda company is lessor. You are lessee. You are what? Lessee. Clear? Lessee. Okay, what is finance lease? Examiner can ask you. It is a lease arrangement in which you get it out of most or all of the useful life of the asset. So let's say, for example, the car life is 5 years. And you have a lease arrangement of 4 years. So 4 out of 5 years, you are using the car. So this is finance lease. This is not operating lease. There are other requirements also, like for example, you have an option that at the end of the lease term, you pay a little amount and get the ownership. So what is this? Finance lease, right? But operating lease is what? Ownership will not transfer. It's like a simple rental payment. You pay, use it, give it back. Khalas. Operating lease. Clear? So how many pages remaining now? Yeah, so good. So we did around 12 pages, right? So I think we can complete it next time as well. So we finished till here. But what I want from you people is, please go through the remaining 8 pages one time. Okay, so it will be easy for you to capture in the next class.